Welcome back. We're keeping our eyes on yields this morning after the Treasury Department announcing it was increasing its buyback limit for longer dated securities by, quote, at least double. Joining us now to discuss is former CEA chair and Harvard Kennedy School professor Jason Furman. Good to see you, Jason. So what do you make of today's announcement by Treasury?
Look, the Treasury can help manage the shape of the curve day to day, but they can't change the underlying fundamentals. As long as we're in a huge AI boom and a huge government borrowing boom, we're going to have high interest rates somewhere in the curve, probably everywhere in the curve.
So basically, you think the bond vigilantes will not be tamed by some of these buyback plans?
Yeah, I think it's a lot like what we saw with the yen intervention, where it works until it doesn't. Longer term, it's really the fundamentals that matter here, and the fundamentals are higher long rates. I should also say this isn't a costless intervention. We're shortening the duration of our debt. That's increasing our exposure to interest rate risk. So one of the biggest things we're worried about with our debt, in some ways we should be more worried now than we were before.
Yeah, Jason, folks are watching the dollar today and trying to talk about, when you try to cap long-term yields and protect your currency, I mean, is the U.S. moving into some kind of Japan-like trap?
Look, ultimately, all this financial engineering just can't get you out of your problems. I mean, if you want to have the exchange rate you want to have the interest rates you want, you need to change your fiscal policy. You need to either cut government spending, raise taxes, or do some combination of both. And right now, that seems to be just far, far off the table.
What do you see as just the key fundamental drivers of yields at the long end? We've heard so many different culprits, but I'm curious what your take is in terms of just the overall competing demands for capital.
Look, I think in some sense they're all true. There's one piece of good news here. We haven't seen break-even inflation rates rise, so this is really about the real rates. There's a lot of credibility that the Fed still has in terms of fighting inflation. Partly the markets think they're going to get there by raising rates over time, so that's part of the increase in long rates we've seen. But a lot of it is just a premium around just this enormous demand for capital coming from two sources. One really productive, which is the AI build-out. The other unproductive, which is the government. And as long as the two of those want capital, they're going to end up crowding out everyone else. And that's what higher interest rates do. They crowd out capital for residential construction, for other building throughout the economy. So it's all channeled to these two voracious consumers of it.
We pointed out the action in gold today, up $120. We did not mention Bitcoin, which, although it's been so suppressed for so long, that's a 10% move today in Bitcoin. And I wonder if you think some of the attention is going to seep into some of these neglected areas that are seen as inflation hedges.
You look at the actual pricing of inflation, and, my own read of the data is that inflation has been elevated by a series of one-offs. You're not seeing it in a tight labor market. You're not seeing it in rising wage growth. And I do believe in the credibility of the Fed, the independence of the Fed. And while Warsh has had his missteps, fundamentally, I think that it continues to be very sound. So for me, I haven't raised my own personal inflation fears that much.
I wonder, some are wondering what Warsh thinks about Treasury's move, if this fits with his overall framework of less intervention, less guidance, and how this gets talked about at Jackson Hole, if at all.
Yeah, I think he's going to try to say as little as possible at Jackson Hole. Maybe he'll do a speech even shorter than what Jay Powell did a couple years ago. But I don't think he minds that all the activity on interest rates and all the press is around an institution other than the Fed. Today, it's about the Treasury. I think he genuinely would like the Fed to be in the headlines less. I'm not sure he's going to be able to get that wish. In some ways, I think he needs to guide things in the way he wants, rather than thinking he can sit back and letting the market figure it all out. But at least for today, the market's focused on someone else, and that's probably a good day for Kevin Warsh.
That's a very good point. Although I think those those days are numbered in terms of turning the attention back over to him.
I agree with that too.